Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by Zacks Chief Equity Strategist, John Blank, to talk about our usual topic. Is there a recession? Nobody's even talking about recession right now, but is there one, or is there one imminent? What should we be looking out for? It's our usual discussion, but it's kind of mixed in with the start of earnings season, the stock market hitting new all-time highs once again, and what is going on out there in the U.S. economy. Kind of some mixed signals right here. So, of course, we have to bring John back on to talk about it all. Welcome back, John.
Thanks, Tracey.
Okay, so I did look at the unemployment data before coming to this podcast.
I got it pulled up myself.
Yeah, and I know that's what we always lead off with.
We always lead off with it, right? We want to be our own best example.
Right. So it's kind of holding steady here. Nothing is screaming terrible. Nothing is screaming great. I did notice one interesting stat. They said the 12-month average now on job gains is 146,000. And it's been mostly hovering around that level for a year now. And last month in June, we had, let me find it, 147. So that's right at the level. April or May, let's go to that one, was revised up 5,000 to 144,000. And then April up 11,000 to 158. So despite some of the headlines and the worries about some more recent tech layoffs, specifically at Microsoft, but there's been a few at Meta and a few other places, it's not looking too bad in the overall economy. What do you think about what this data is telling us?
Well, I'll throw something out on top of this. This is a coincident indicator, right? Payrolls are a coincident indicator. So we're learning about the strength of the economy now. It should not be in question. Right now, as we speak, on July the 15th, with the weekly claims coming in for July that we know are low, with the June numbers at 147, with a household unemployment of 4.1%, there's really no reason to worry other than this issue. The jobs that are coming in this latest report are very indicative of what's happened for the last few months, which is state and local government and healthcare. And the state government is basically teachers. So 69,000 people so far have showed up in the data as have losing their job at the federal government level, which, given the noise we heard about earlier, that's just another indication of why you got to be careful with news, because 69,000 over 6 months really doesn't turn the dial at all. However, Tracey, the big issue right now is this statement, and I'm going to read it from the conference board verbatim. The leading economic indicators, negative 6-month growth rate and contraction in the diffusion index over the past 6 months triggered the recession signal in May. And I'll tell you, here's all the things that are not working anymore. Consumer expectations for business conditions, way down. ISM new orders, way down. Building permits, private housing, way down. Weekly hours are holding up decently. Manufacturing new orders are flat. Manufacturing new orders for consumer goods are down. And weekly claims are slightly down. The only thing that seems to have done reasonably well is the S&P 500 stock index. That is, it's a treacherous situation because all the real indicators within the leading indicators, the real employment indicators, the real activity indicators are negative, other than the financial component in a stock market is a leading indicator and it is positive. But this is the real issue is, it's usually the case when things finally roll over that this leading economic indicator is probably now telling us something we need to take seriously for the first time since we've done these podcasts.
How long after it gives the signal does it usually happen? Is there like a historic precedence? Like there was when the Fed raises rates, we usually get a recession 12 to 24 months after. Is that true of the Conference Board data too?
Yeah, I mean, basically, just like the yield curve inversion, coming out of COVID, we were just sliding down the supply curve for labor. So it was kind of giving a poor signal because of the way it was being, the data was coming in. It was the big surge and then a pullback. Now, this is truly a cyclical turn, and yeah, in general, just like we're seeing with the Federal Reserve, two cuts this year and two next year, the soft landing story. Um, when you look at this point in a cycle, it tends to be very sanguine until it's not.
Right.
And, so what happens here is, for example, I was on a call not too long ago, just July the 3rd, with someone who has a 50% recession call for 2025. 50%. And it's a reputable outfit. And they took me through a lot of the vacancy rates in the real estate market. For example, office real estate at the macro level in the United States is 20%.
Yeah.
So, I mean, again, you say,
Terrible.
okay, so John, why didn't it happen? It's been 20% for a while. Correct, Tracy. So when does the balloon payments, when does the bank, giving you an extra break, when does it all end? And it typically ends all together. All the banks just decide they're going to go down and suck it up, right?
Right.
And that's what happens. So what's happening is already in our face. Tariffing rates are at 18%, and we haven't seen this in the 1930s. And again, you say, well, why hasn't that happened yet? Well, it has happened at the ISM level, last data. Certainly has happened. And, it's still going to take time for it to percolate into the quarterly data. And when people took all the imports in the first quarter and through the early part of the second quarter, they're going to be able to run off those stocks of inventories for some time and get away with it. And then, as someone correctly points out, given the lower earnings outlooks, that a lot of these tariffs are getting eaten for now. But at some point, particularly in the small and middle-sized businesses, where they just don't feel like they can do that anymore, they don't have the margin like the big companies do. They're going to start letting people go. And again, when does that happen? When there's kind of a herding mentality, Tracy.
Okay. So we've had we're already in a recession with several just individual industries. Like you mentioned real estate, but even on the residential side, that's taking a turn to the downturn now, even more than it was. And then manufacturing, I think the Chicago PMI has been negative or under 50, showing contraction for over 18 months now. So do those recover first, or can they provide an impetus to push the rest of the economy into it? Because then on the other side, we have 500 billion in spending by about 10 companies on the AI revolution.
Yeah, I mean, okay, Tracy, I threw this out a week ago. I'll throw it back at you now. Nvidia sales for 2025 are 130 billion. You threw out 450 billion as the AI boom in capex, which I think is okay. So a quarter of is Nvidia correctly, right?
Yeah.
450 billion on an economy of 30.5 trillion is how big?
It's pretty small.
Yeah, it's basically 1.3% of the US economy.
Right.
Now, I also threw this out to you. So we think about this. This goes back to the leading indicators in the stock market outperforming. So let's talk about that. Nvidia market cap, 4 trillion.
Yeah.
Nvidia market beta, 2.0. S&P total market capitalization, 52.8 trillion. Basically, almost twice the GDP. And Nvidia itself at 4 trillion is 7.5% of the S&P 500. So the entire AI boom is 1.2%, and 1/4 of that stuff is one company with 7.5% coverage at a 2 beta. So you say to yourself, what is wrong with this picture? I mean, you're just as a stock investor, Tracy, be the value investor for me and tell me what's wrong.
Well, it is very concentrated in a couple of these names,
That was
obviously.
diplomatic, Tracy.
But when I look at some of the others, we still do have breakouts going on in other industries, though. But some of them are somewhat tied back into the data center AI play sometimes, but they're not as big a companies, even though they're big market caps, but nothing is close to Nvidia's with the 4 trillion. So that gives me a little bit of a pause that, maybe it's being stretched into some of these other companies now too. And I'm thinking mostly of a company that just reported this week, Fastenal. Now they're kind of interesting, and I can't really figure them out per se, although someone was just arguing with me on social media, on X, that it's always traded with a premium, and this is no different. So you can see the shares are at new all-time highs. I brought up the chart. Another beat earlier this week, but it described market conditions as sluggish. So Fastenal makes the fasteners, but they have other product lines on like kind of the construction side. So that side, the non-residential construction business of theirs is doing quite well because data centers, they're like everywhere. Everybody has some kind of exposure to the data centers, it seems. So that part is somewhat making up for the slowness in the fasteners, but I look at the valuations on this. I'm scrolling down. The forward P is now 41 times with a PEG of 4.1. It does have some decent earnings growth this year and next, 10% for next year, but it's really pricey here, but nothing is stopping it.
I'll tell you what interests me in that chart, Tracy, is look at the 2027 earnings line, the brown line.
Well, right. They don't know what's going on there.
The Liberation Day went from 130 to 110.
Yeah.
And then it popped back up on the news of the 90-day respite. So you can look, and there is your uncertainty interval for this stock.
For sure.
Yeah. And then that says that, 2 years of growth, they're going to take it from 2027, doing growth above that 2025 line. You're going all the way back down to basically where things were 2 years ago in a flash, right?
Oh, yeah.
Yeah. So you say to yourself, what should I do with a 41 PE stock, a chaotic tariffing situation? What should I do? Tracy, again, as the value investor, what should you do? I mean, I'm
not in Fastenal for these reasons.
Yeah,
it's just way too pricey for me.
This podcast, you're not in Fastenal for good reasons, because investing, this is a trading market. I mean, it's a Bitcoin market. It is a meme stock market. But this is really when you lose your shirt as an investor.
Well, it is about market timing, right? Because we know it's not going to keep trading at 41 times for forever. But when is it going to stop? When is the music going to stop and we don't have a chair? We don't know.
No, we don't. But, a lot of our subscribers, a lot of listeners here are people who are older, and we have to sit down and say to ourselves, the S&P 500 trades at 24 times current earnings, 24 times. In a recession, let's throw out a number that you could expect, 14 times earnings. So just look at your portfolio, do that math, 24 minus 14 over 24, so that's 10 over 24, so you're going to do a 40% haircut on the value of your stock portfolio. Do that, just do the math. And then say to yourself, okay, this might last 2 years, right? So then say to yourself, what level of money markets do I need to have to sit on all those stocks for that length of time? Right? I mean, I don't know when it's going to happen, but I do know we need to have these dialogues with people and say, look, if it's the bond market's going to take down the stock market, you don't want to put 60-40 together either with bonds and stocks. You want money markets getting 4%, and you want to sit there and say, okay, when I look at my finances and I gross it out and how much I'm going to need, I can live through a 40% haircut in my stock sometime in the next 3 to 5 years. And it might be the next year or two.
Right.
Yeah,
But I feel like
that's investing, right? That's investing, right?
But I feel like the problem with that is that we have seen a couple of big haircuts recently, including this year. We were down 19% on the S&P 500 and over 20 on the NASDAQ, and then it came right back. So people are believing every time we're going to get the rebound. And we saw this in the late 1990s too. We came back off of crazy sell-offs in the late 1990s until in March 2000 we didn't we never came back. And so, but how do you don't necessarily time, because as I tell people, I was sitting in an office in San Francisco at the peak of the NASDAQ, and none of us then realized it was the peak, because we had been trained by these rebounds in the prior years that it always is going to come back, and this is how it is. And I do think a company like Fastenal, when you look at that chart, that is telling you it's not Nvidia. And so you feel a little comforted by that. Like, look, there's these other companies that are also, the stocks are doing this well. So it's not just crazy AI or tech. And that's a good thing. There must be some fundamentals under there. And so I think that, because it is a little broader, like this morning, I did a earnings all-star video, and Cintas is reporting this week, the uniform guys, and their chart looks a lot like the Fastenal chart or the Nvidia chart. It's at 5-year highs, it's outperforming, and it's trading at 44 times. But nobody cares. And so when people own these, and if you've owned Cintas for the last 5 years, you're up 206%. And it keeps rebounding off of the sell-offs like all the stocks do. And so you just assume, oh, this is going to keep going. So I think that's one of the dangers out there. We do think we will continue to get the rebounds, but no one knows when we won't. So,
yeah, well, this is when we get back to the economics, and I'm just going to read you just stuff straight off the Conference Board website, not my language. A strong rebound in stock prices in May relative to April was not enough. Let me repeat that, was not enough to offset negative impacts from weak consumer confidence and new orders. And I'll repeat what I already said earlier in the show. The leading economic indicator is negative 6-month growth rate. So over a long time, averaged out, and contraction in the diffusion index, so the change is getting worse, over the past 6 months triggered the recession signal in May, right? So this is the weighting you're talking about. I mean, the rebound in stock prices happened, but it was not enough to offset the negative impacts into the macroeconomic scenario that they have trusted and put together over the last decades, right? So, I mean, again, I don't think you should get out of stocks, period. I agree with you that this can keep bouncing and going higher and higher and higher for a year or two. But the music will stop. And
it always does.
It always does. And
yeah.
When it does, all these things pile in together, because then everybody says, oh, I got, it's a hurting thing, right? So, and you have it in your face. I just read it to you. And I can look at this chart in 2019, 98, and these other areas. Very similar situation. And the problem with these stories is, you've been wrong to call it out for years, so you don't call it out now. You kind of get fatigued on calling it out. And that's the other thing that's kind of beguiling, is like, well, so I haven't called it out for years now. Now you're calling it out, so you're the boy cried wolf, and I don't want to listen to you, or you're just fatigued. And so it's almost impossible. But what I'm saying is, I think, money markets at a high level in a portfolio for an investor right now make a lot of sense, particularly if you're older. That's not my only thing I'm telling people. I don't have an answer for you other than you're going to wake up with a lot less of a risk profile, not worry about what's happening in the news, and not get caught by a big hurting event. Because you'll say, hey, you know what? I got enough cash to pay everything for the 3 years where the thing bounces around. And I just, I do hold some of it so I don't catch the turn. I'm still in it. And then I get back when there's more of a same number. And there's a huge upside for you. You can put that other money back in at 14 times earnings.
Right. For sure.
Yeah, I hate the one thing I don't like, the lesson that everybody does tell you, which I don't disagree with, is not to time markets, but in the face of this type of stuff, lowering your risk profile makes a lot of sense. We should tell people to do so.
Yeah, it certainly depends on what your goals are, where you are on the investing cycle. But recently, sometimes they run these personal finance stories on the radio, and on like Sunday morning. And I was kind of listening to one the other day, and I couldn't figure it out at first. I was like, is this old? Because the numbers they were giving were very strange to me for like the current period about the stock market. But the scenario was, it was a couple age 65. I started listening in right when they were giving like a little bit of the background. So I missed a little bit in the beginning, but they decided to retire at age 65. They had $1 million retirement portfolio. They wanted to take out $50,000 a year, but they retired in 2000. It turns out. I only figured it out later as the episode went on. They retired in 2000. 40% of their portfolio was in the NASDAQ because look what had gone on the last couple of years. Like, you were kind of dumb not to be in it. And if you didn't rebalance, it became this big portion of their portfolio. So they were at risk, but they didn't know it, like I didn't know in my office in San Francisco in 2000 either. So they retire. The NASDAQ does its thing. It's down 83% over the next 3 years. Their $1 million, they told the radio guy, it went down to 420,000, their $1 million portfolio, but they had taken out 50,000 a year for those by 2004. It was down to 410, but this is like scary when you're retired. Then they got a rebound because the stock market did rebound into 2007 highs. The S&P hit a new high then. NASDAQ was still not good, but they didn't say maybe they got out of the NASDAQ at that point at the lows and then, got into other things. But they did get it back to 520,000 by 2007. But then we had the financial crisis, which crushed it all down again. And meanwhile, they were taking out the 50,000 to live off of, plus their Social Security. And then by the time they were calling into the show, it was 2012, I figured out. And so it was 12 years after. They were now 77 and they only had 110,000 left. So, but that's the sequence of risk. If you are all in right when the downturn happens.
Yeah, now let's do this, Tracy. Let's talk it through if they have 50-50 at the million. They got 50-50 on the money markets versus the NASDAQ. So the million, half of it's ICE, and it makes 4%. So there's 20 grand a year in income. So now they're only pulling 30 grand out. The 500,000 goes to 300,000. They only lose 200,000. And so now they're at 700,000 with 20,000 in income. So they only got to get 30,000 to draw it out. They draw down 30,000 for 3 years when it comes back, and it doesn't have to be as bounced as high or as much. And that whole time you got some income and you're just rolling along. So this is the thing I think we need to make sure people understand. Just sit down and do the math and take some risk off the table. Doesn't mean get out of stocks. But you should not be like queuing up, 3x NASDAQ puts, or
right.
calls and like playing the game like it's going on forever. Do not do that.
Yeah. But what happens if you are not the ones who are close to retirement and in your 60s or even 50s and you're 35 and you have been investing since the start of this bull market, basically since 2012, and you built up this nice nest egg? Maybe you're putting, I've seen some people say they're putting 40-50% of their like 401k money into the S&P 500 fund, because again, that this time it's the S&P that's really crushing it more than the NASDAQ, it seems. So people are really focused on it, and the returns have been great over the last 5 years. It's averaging 19% without even the dividend. I mean, that is, if you can do that, you're doing really well for yourself. But what should that person be doing, if anything? Because they have plenty of time to ride it out
Yeah,
if it
yeah.
does
I
come
think
crashing
there is a
down.
case where you just stay aggressive and you just deal with it. I mean, the 30-something person should just shrug their shoulders. They don't have enough in yet, and they're going to buy whatever they're going to buy at prices for just across it, and then the traditional advice sort of sticks. But even there, um, I really believe a 20% position right now in money markets is advised. 20%, not 50, 20. 20%, not 5%, right? Because you can then at least you can ride the thing out with some peace of mind. B, when we talk these payrolls, what you want to do when the back end comes, when the downturn does come and the payrolls fall apart, is once they curl up, once they start curling up, you put all that money to work, right? See, I really think, that's why we're trying to teach these people this payroll thing. If you just do it, you're not going to be perfect at all, for sure, guaranteed. So just take that off the table. It's not a timing thing. It's just like this is the better cyclical way to acknowledge cycles and to just basically tie some of your portfolio to the acknowledgement of these situations, right? I'm really not in the case of just sitting there staring at all this stuff and saying, gee, 41 times earnings, 24 times the S&P, 7% the NASDAQ, is in one friggin' stock, and going, yeah, just relax, right? We've been in a momentum trading market for a long, long time, and we do have an episode that's most similar to now, which is that 2000 thing. And yeah, it wasn't a bad downturn from an unemployment scenario. It did get to 6.5%, but it was a really, really crummy place for stocks. And we just got to we got to let people understand it. You're not going to get this right. You definitely want to play stocks. It's definitely true. My own father in his 80s plays stocks. He's in it. He loves it. He gets it. He knows how to survive downturns, but he also owns a lot of municipal bonds.
Right, right. Yes, diverse portfolio is key. For
Yes,
sure.
and you got to get these income. Just get your income number. Income number, whether it's dividend stocks, preferreds, munis, money markets. Get the income number to where you say, okay, there's a nice income number coming in on a monthly or quarterly basis. I'm good with that number, right? Because the other thing is, you just don't want to be the guy, looking like a Goldman Sachs partner with no hair and 50 pounds overweight, worrying about this stuff.
Right, right, for sure. Everybody should know their risk tolerance as well. If you aren't sleeping at night because you're concerned about, Nvidia hitting new all-time highs every day and that it may not hold that, then you need to make some changes. That's what I always tell people.
Yeah, that's all I'm saying too. I just think people, they get trapped into thinking they should stay with the same risk profile and be super aggressive because the trade always worked that way. And when you're in these situations, like I told you with the unemployment indicators and all the activity indicators, tariffing it, things we haven't seen since the 1930s, housing markets rolling over, real estate markets outside of housing rolling over. Um, you just got to look in the mirror and go, this is what it is. What do I want to do about this? And what is going to make me not pull my hair out, not scream and get a divorce, fight with my neighbors, just get through life and go, hey, you know what? I just started living on income. I got my income game together, basically.
What about those who aren't in the hottest names? Like I just put up the chart of Nvidia. As I said, it is hitting new all-time highs now again on the news that it's going to be able to sell to the Chinese, it looks like. So shares have taken off again, and they're out of that narrow trading range for the last year or so they've been in it. And you can see the earnings growth is still expected to be solid, and forward PEs at 38 now. That's not too bad for Nvidia, even historically. Here's the earnings growth. They just reported in May the first quarter of 2026 because they're on the fiscal year. So this year, 41%. Next fiscal year, 31.8 there. So that's pretty nice earnings growth still. But there are definitely people who aren't in this, even though they are in it if they own the S&P 500, but as an individual holding. And I know there's people thinking again, hey, maybe I do need to buy it here. What is your take on getting in now?
Yeah, click on the analyst report, Tracey. I want to go to the sales estimates for 26 and so on to 27. Click on the analyst thing. I mean, just sit it down and think about this itself. These are expectations for earnings from, you saw the big uptick from 23 to 24 to 25 in that chart, right? 25 annual earnings, which we're now halfway through. So this is a decent number, but it's probably high itself, is 130 billion. 26 is 195 billion. 2 years from now, 240, almost doubling of the earnings through sales. Not earnings, sales. So do we think Nvidia will double its sales from this point after 3 years of incredible runs going out 2 years? Yes or no?
Some people are saying yes. They
Yeah,
do
of course.
believe it
Now,
will
enough
happen.
analysts put this together that I'm
Yeah.
talking about what
I
the
mean,
analysts
some
will say.
analysts are
But
thinking
again, if we
yes.
just step back and say, hold it, I've been doing this for 3 years. How many more markets are there? How many more places can I
Well,
get?
China will be big, but I have been saying that we will never see numbers like this ever again on the sales growth side, because it is just been incredible already over the last 2 years.
Yeah, and the other thing is, I haven't put this 130 billion to work in my Blackwell chips. You say, yeah, it's the next generation, but that's like a new car that, another year older. And you say, well, yeah, maybe it's better from a chip perspective, but if I can still get my large language models to run really well and my team has gotten used to the given data center, I might wait 2 more years, 3 more years for a really, really good chip. Right? So the idea here is that when does the market start to say, you know what, I'll wait 5 years for the next Blackwell chip and I'm good. I'm good because my CFO is telling me he needs to amortize these data centers for 5 years. And that the engineering guys are saying they're not really, that concerned about the latency, computational power, given the chips they own, and they're really not having competitive effects. And it gets to be a CFO thing, and you just go, well, we're not doing it, right? It's not a CEO thing; it's a CFO thing. Just advertise it, depreciate it, and don't buy it now.
Right. Yes, nobody can really time that. Again, this kind of does remind me of the late 1990s when everybody thought we would be buying Cisco switches for forever as well.
Right. Yeah. No,
And
remember
then we didn't.
Intel.
Yeah.
Intel was the stock that didn't do wrong until it did a lot of wrong. I mean, this is the problem here. I mean, this is called narrative investing, and the narrative is long in the tooth. Look at that chart. That chart for EPS. So it started at 24. The big hook from 23 to 25 is in place. And of course, you say, yeah, look, the next step, just getting my pencil out is 25 to 6 to 6 to 7. And look at that. We're at 250 billion in sales. But you know what? I'm going to say to myself, woo, I bought the 2025 chip. I got a recession. My customers are going to be pushing back on me. My large language model is fine at this point. I don't even haven't incorporated a lot of the changes into my company yet. My line managers are not pushing me hard on this thing. I'm delaying it. I'm not saying I'm not going to do it. I'm just saying I'm delaying it. Right? I mean, this happened with electric vehicles. Remember, we were supposed to be at whatever penetration, and Tesla was going to grow until it's forever. And now Tesla has, basically peaked 3 years ago from a sales perspective. And yeah, is China in electric vehicles, doing a profound change? Absolutely, absolutely. Now go ahead and try invest in that and make it happen.
So you're saying unless you're trading Nvidia, if you're a trader, then you might be interested. But otherwise, long-term investors, it's too late.
I think so. I mean, again, history tells you. Look, Vanguard itself. Let's talk Vanguard's projections for the S&P 500 returns from a 24 PE is 3.9% annually. That's Vanguard. You can say, well, Vanguard, John Bogle. I mean, he's an old guy. He's gone now. I mean, it's stodgy stuff. I'm like, yeah, you know what? It's called investing, right? We're just talking about trading. Yeah, you can definitely play these names. I've had no trouble getting out of the way of all our Bitcoin portfolios for many years, right? Because it's been the right trade from a trading perspective. Absolutely. But now tell me if I want to buy Bitcoin at 120,000 after 16-month rally for my portfolio and my 401k. Answer is no way. This is like, this is the discussion people need to have is, yeah, you want to trade some, keep yourself involved in these stocks so you understand what they're doing and you can learn a lot by you pay better attention to them. Definitely make a lot of money. And there's definitely a reason for doing that. And there's definitely a reason to have a super strong portfolio position in stocks. Don't get me wrong. All that's super important. But then just stop and look in the mirror and go, hey, you know what? What am I doing this for in my real life? How am I going to live on income in the situations that I can have handed to me in a manner that's not going to cause me to go crazy? If there's a pullback, and like again, 24 to 14 in your bear case should be your standard stress assessment. Yeah, just do the math. Like, how do I survive a 40% stock market pullback? What do I need to set my weights up to survive it for 2 years?
Yeah. Is this why you think Buffett is still just kind of sitting in all that cash?
Yeah.
He is the value investor guru after all, and most things are fairly stretched. As a value investor myself, I have been able to find some cheap stocks right now, but in technology, for instance, they're mostly not there. So he is just sitting there in the cash, but he's getting the treasuries and he is getting quite a return on it every quarter.
Yeah, I think, well, the other thing we don't know with Buffett is, the transition to the other managers and whether he wants to leave a cleaner hand for people to play. And he doesn't want to hand positions off to those people. So there is an amount of cash that's related to that. The other part is he's a value investor, like you're saying. And he's not been wrong again. Like, again, Warren Buffett's too old. This time he's wrong. Just if he's wrong, then the leading indicators of the U.S. leading indicators from the Conference Board are wrong. If he's wrong, then there's no cyclical growth in any of the non-farm payroll areas. It's all state and local government and stuff like that. There's no cyclical upside to this employment. It's not falling apart, but there's no cyclical upside. And then, yeah, you said, well, we haven't seen the prices rise. Really? Did you pay attention to the CPI this morning? Did you pay attention to this year's ISM for June, where the prices paid on manufacturing at the ISM in June were 60 something?
Yeah.
You say, oh, I missed that. Well, I didn't.
Right. Right.
Right? Look, some things are going to happen you're never ever, as we've always talked about, you're never going to get the weighting right. So the guys who blew the last call, the bears missed Nvidia. They missed the AI boom. They missed a huge structural change. They missed the fact that valuations can keep going. Then they also missed that we were leaving a supply shock and people were just going to be filtering back into the economy down the supply curve for 3-4 years. It doesn't matter. They missed all that. But now all of that's behind us. And there's a sense in my mind of something more properly cyclical in place. And the thing that sent me the other direction is what's different than last year. I'll tell you what's different, Tracy. 20% average tariffs are different. I have the macroeconomic story in hand. And then you add in, finally, I've known the office vacancy rate's poor, but now the residential market's falling apart in a lot of this part of the country. And then you say quits. Your job openings are 2 to 4% above the 2019 level, but the quits are lower. So what's happening? People are keeping jobs. They're not finding jobs, and they're getting cautious. And I've had people, at car dealerships, what I've dealt with, saying, look, a lot of used car selling, a lot of people not pulling the trigger on stuff this year. Caution. And why wouldn't you be cautious? Because, and it's just normal, like we talked about. I am preaching caution, right?
Yeah.
And
the only area I feel they are not cautious on the consumer side is travel. On the cruises, they're all still seeing the cruises. And as soon as their stock portfolio hits another high, they do feel good, as we all do. Like, oh, wow, look at all that money I made. It's back. And they are booking the cruise for 2026, 2027.
Yeah, but there you got a situation that makes a ton of sense. You poke $5,000 into a tour of the Adriatic with your friends and your family or your wife or whatever, and you say, hey, I got it out there. It's $5,000, not $50,000. It's not a $70,000 Model Y,
right? For sure,
it's not a house,
right?
And I get an experience out of it, and it's discretionary spending that I want to do no matter what, anyways, because the time's going to pass and I'm going to lose the time.
Right.
So, I think experientially, the experience economy after COVID is very much alive and well, right?
Yeah, for
the
sure.
other thing that's alive and well in the post-COVID world is this divergence between screen-based manias and the real economy, right?
What do you mean by that?
Bitcoin's up, 100% over the year.
The meme stocks.
We've had massive amount of penny stock trading. So it's more fun to see stuff move on screens if you're staring at them all the time, if things go up. But then I look down around my neighborhood, the sheer number of closed storefronts from small and mid-sized businesses that are getting pushed out because they cannot get enough business given the rents they're paying. And that cycle is rolling over a lot of places. They're just saying, hey, you know what? I'll just either A, I own the building, I'm get out at the top of the market, or B, I just can't pay the rent on the market because I don't own the building. And the retailers are out there saying, I'm doing fine, but you're just pushing me into this wedge, right? And when does the capitulation start to sound a lot louder? I don't know, but this is another thing that's happening after 2 to 3 years ex-COVID. I feel like what's a lot of happening down in Florida. You're seeing people went down there. It made sense to go down there in COVID, but now you're like the novelty's off. The insurance rates are higher. I don't need 2 houses. I'm a Canadian guy. I don't like Americans anymore. I'm going back to Toronto.
Right.
That's happening a lot.
Yeah.
And you say, you know what? Let's just get out of the top of the market, get out of this, this thing. It's all over anyways. We can go to Costa Rica at this point,
Right.
And you're gone.
Yes,
and
Costa Rica, Panama. Panama.
There's several thousand for sale signs in Cape Coral, Florida. And then you say, okay, that's Cape Coral, Florida. Do Georgia. Okay. Georgia. Maybe it works. People move up there, keep the market stable for a while. Tennessee, probably, some upside. But then, get into stuff like what's going on in Arizona. It's too hot there now.
Right. Yes.
I've just an amazing number of Arizonas I'm meeting the last few weeks. Hey, where are you from? Oh, I'm from Scottsdale. Oh, really? You like the last guy from Gilbert? Gee, hey, what's going on? Well, it's 110 out there. It's 120 out there.
Right. It was
I've had enough,
117.
you know?
Yeah.
And you say, well, I'm really from Minnesota, and now I'm sitting in an air conditioning in Phoenix. Family's up in Minnesota. I'm done. We're selling the house.
Yeah. But I feel like, John, this is the gloomiest I've seen you whenever we've done this episode. Because we've done this every couple of months for several years now. And seems to be the gloomiest where you actually do think a recession is coming soon.
Yeah, I do. I mean, I got to be honest. I did a call with BCA Research just on the 3rd of July with Peter Berezin. But I've respected BCA Research for a long time. They have these diffusion indexes. They do a really good job. And he laid out for an entire hour the bear case on the recession story. And I did not listen to him last year, as you know. But when you tell me I'm in an economy that's trashing the immigration, trashing the tariffing situation to 1930s levels, and I'm seeing no cyclical growth in jobs whatsoever, and I'm seeing 24 PEs in stocks broadly, and I'm looking at all of this and thinking, yeah, sure, it's fine.
Yeah.
You're laughing because it's just not fine. I don't
Right.
know when it happens, but we got to start accepting, the basic cyclical information that I provided you from the leading indicators, that all the real activity indicators, all of them in the leading indicator index are negative. I mean, before, there was a lot of things that they were mixed. It was, during the supply shock thing, there was ways to look into the sub indices, but now I've got my excess catalyst. There's excess tariffs. I've got a housing downturn in place that could drive down that sector. And I say to myself, doesn't feel good. And it's being reflected in established indicators that tend to indicate this correctly within 6 months or so. So 6 months from now, and we're still not in this, I'm totally fine with that call. But 2026, as we enter it and the market starts pricing it and seeing it little by little by little until what happens, right? And again, I mean, we're not going to call it on a coincident basis at 147,000 payrolls in June. That is certainly a strong economy now, right? And the 2.6% growth rate on the latest Atlanta Fed is solid, right? That's trend performance and even slightly above trend performance. So it's not in the indicators at the coincident level at all. But it is now completely baked in, and I get the link in and the follow through on these sectors, like you're talking about. You already told me, this sector's in recession. That yes, they are. So how long before the waiting and the persistence of that contraction expands to enough of the economy that the entire ship starts to sink and causing other problems? I don't know. That is absolutely the biggest problem in macroeconomics. It's you're in a structural cyclical moment in time where you have almost no way to understand how to weight and time these factors within the economy, much less the stock market, right? And you just totally get them wrong. However, I can look at enough patterns in the yield curve inversions, in the leading indicators, and the length of time I've been pulling away from this is the same thing. It's like, well, now is really when it starts to matter, you know. And like I said, I certainly would stay with stocks. I would certainly be belief in the unemployment rate staying low for another few months. All those things I'm fine with. But I think it's just going to be a moment of conclusiveness out there that one needs to at least put a higher probability on. Is what I would say.
And what do you think the Fed is going to do? Obviously, July, we're recording this before the July meeting, but any kind of rate cuts seem to be off the table now after the CPI. And they're not meeting again until September.
Right? And they'll cut in September.
Oh,
Seven
you think
days
so?
are your base case. That's soft landing stuff. And now you got two new scenarios. One is the president fires Powell, takes it to 1%. So you tell me, the president. One day you wake up, Tracey, and it's not a low probability event, and the president of the United States has fired Jerome Powell, and he's put in a flunky, and he took the Fed funds rate to 1%. Is that going to be good news, Tracey?
No.
Well, yeah, that's my point. That is
Not at all.
that is exactly what happens in all the chart patterns you see in history. Suddenly, the Fed cuts massively in the face of weakness. This is the thing. You think, oh man, he's going to fix this thing. No. First of all, tariff rates, if he doesn't lower them, are the issue. And raising the level of uncertainty means the hurdle rate for investment's higher, and the higher or lower interest rates are going to matter less and less in that calculus. And it's going to be ignored like it always is in these recessions for a while. So it's just, and then you say, when am I going to wake up for the 1% rate and Powell's fired? Fired. Well, you and I have never seen this in our lifetime. We have never had the Fed independence questioned in the manner that it is right now in our lifetime. So, do you want to sit there and say, John, just ignore it? Just ignore it. Like, really? Eventually, for example, the tariffing, it could go away. The laws are not allowing the emergency actions that have taken place. He has already lost a court case at the International Trade Court. He's appealed it. So there's this thing called Section 232 National Security Act of 1970. And he's got several of these 232 section filings. And guess what he's going to find out, Tracey, in every single one? It's a national security event everywhere because he says so.
Right.
And so we're going to replace one set of tariffing issues as they disappear with these ones because he's committed to this idea that we need to wall ourselves off from the encroachment of the global economy to the U.S. system and rebuild ourselves in a manner that is, more domestically oriented. And he's committed to that. And, having looked into this, the basic problem with any manufacturing revival you take on is it's substantially related to a lot of tangible incentives and agreements that you need to make with given industries and executives over 3 to 4 years of time. And that is the model that I have in my mind of what would achieve what he's seeking to achieve. What he's going to achieve, in my mind, is he's going to raise prices, cut volumes, and lower jobs. At least for a year. And after that, in the midst of all this other weakness, so then he cuts jobs and the housing market's weakened. And then people lose their jobs. They start getting rid of houses. Then they cause more housing weakness. And you just start looking around and going, tough for me not to understand the knock-on effects of 12 months of weakness from tariffs.
Right.
And, again, I just got to look and say, I understand the basic, will to drive up real activity. And the Biden administration did do that with the infrastructure plans, the CHIPS Act. They had a similar set of objectives. They just had a different set of policies and ways to go about getting them. And so, at a goal level, I get it. At a tactical level, I get the macroeconomics and they're weak. And that's basically it. And so does he get it? Actually, he gets my macroeconomic weakness too. That's why he's going to fire Powell.
Right. We do know from the 2018 tariffs on the appliances, on the washer dryers, that it took a number of months for those prices to rise because they were mostly made outside the US. But some of the manufacturers, like Samsung in particular, did decide to open up a US manufacturing plant like a year into it because they would save them a lot of money. And so they did. It's still operating. And so they still are making the washer dryers here. And then I did just recently hear that GE Appliances, which is now owned by the Chinese, actually.
Right, higher owns. Yeah.
Yeah. They also are going to open up a big manufacturing plant in Kentucky, I think it was. And they are going to make some of the appliances here now, too, to follow along with Samsung and try to avoid those tariffs on China.
Yeah,
So
there's no question some of it's going to happen. Again, this is a macroeconomic exercise of how much and when and where. And it's almost impossible to say how much and when and where.
right. Some things we can't really easily bring back, though. Like even just shoes, making shoes is not an easy item to make. And we haven't really done it outside of shoes for the military in many years. And so that would take a number of years to ramp up if they were ever going to try to do it.
It's just the expertise, the logistical challenges of factory placement and investment and training and exiting into marketing and sales of the new goods in the new place, 3 to 4 years. I mean, so, being impatient at the executive level and immediately rating tariffs at 20%, but doing it in a manner that can be challenged in courts and slog it out for two years, not an optimal manner in which to address these objectives. And,
Well, we'll see, because we're going down this path.
yeah, I mean, this is, again, I don't drink the Kool-Aid. You guys, everybody knows this, and but but happy I'm not drinking the Kool-Aid because I'm not glassy-eyed about the situation. And nonetheless, I mean, again, as you pointed out correctly, with all the anticipation the market has correctly gotten, including this election result, we're up 22% for 2-3 years. And you missed it if you didn't get it. So, I mean, my bearishness should be also taken with a grain of salt and realize people climb walls of worries and some policies go away that you didn't see and some things that are super bullish happen. And trading and investing in stocks is still very valid right now in all these environments. And it would not surprise me, 10, 12% return in equities this year. And I have not, my own asset allocation for Zacks, gone below market rates on large cap stocks. And I'm, because I'm going to wait till the coincident indicators roll over. I'm going to be super slow on that. But, this is valid points. I mean, you can't call any more than you can call, fear. You also can't do a very good job with hope.
Right.
We're very poor at saying, yeah, that's definitely going to work.
Right.
Can't do it.
I wish we had the crystal ball to tell us, but we don't.
We don't.
Yeah.
We did not have it. And, but I do think, you look at correlation matrices of stocks and, they're 70, 80% correlated most of the time. So you're either in them or you're not in them. In this environment where there's so many correlated assets, and you just got to understand, okay, what is my income perspective here and what do I have to build up to make myself in a little more of a fortress-like scenario for myself.
Yeah. One of the, before we wrap up, I did want to mention one of the indicators I do look at for, possible recession is like what the energy market is doing. And it's going the wrong way. If we're going to have a boom, I'm not sure why crude would be at this level.
Yeah. So Tracey, $67 a barrel, $68 a barrel right now. I just did the global macro for Zacks. It's been really reliable for me for a long time. So what's the 12-month look?
Not good.
What I'll tell you what it is, $61 a barrel.
61, yeah. I've seen it as low as like low 50s.
61, are you betting on a huge global economic boom?
No.
No, you're not, Tracey. You know what the growth rate in Mexico is this year? The growth rate in Mexico, what is it? It's
I don't know.
0, Tracey.
Is it 0 now?
Did you hear that? No, you did not.
No,
I'm telling you that because I got the data from London, and then we're doing a podcast, and I looked, and it's zero.
Yeah,
Now,
that's not good.
that's our neighbor.
Right.
They're our manufacturing partner. They are at a 0% projected growth rate for 2025. And again, you say, John, it's not negative. I got it, Tracy. 0-0. I don't know that's a boom either, Tracy. That's just not, what do you want me to say? Like, it's good. We drove Mexico to a 0% growth rate for 2025, John. And
well, we know that
say?
it's
Like,
not
great.
good. Yeah. With energy prices at these levels, it's not a good sign to have gasoline under $2 a gallon. As much as we like that because we are spending less at the pump, but that is telling you something is not
well,
right.
The other thing I noticed in the latest CPI numbers is, the last 12 months gas, energy year-on-year numbers are negative, which you're talking to. The food prices are 3% annualized up.
Right.
Food prices.
Yeah,
so,
we're feeling it at the grocery store.
Energy prices, but food prices, if you haven't shopped or haven't gone to a restaurant, are knocking down a fair amount of change for stuff. And the biggest thing I've noticed further into my global macros, the live cattle and beef prices are.
Oh, for sure. Beef is at all-time highs. Yeah.
Yeah. So you say to yourself, really? It's going to be time to go 100% aggressive momentum trading?
Yeah.
Nah.
Well, come on to the value investor side.
Maybe I'm in the wrong podcast. Maybe I should have done the value investor.
Right. You should have done. We'll have you on. We'll have you on soon to talk about all the values. All right. Let's leave it at that for today's podcast. We did talk about a couple stocks. Fastenal, it's ticker FAST. Nvidia, of course, NVDA. We mentioned Cintas. They're reporting this week that we're recording this the week of July 14th. So check out their earnings report, CTAS. These are all stocks trading near their all-time highs, all in different industries. So we'll see what this earnings season turns out to be. Fastenal's already beaten, and they're already still hitting new highs off of their beat. So be sure to subscribe to get all of our podcasts here. We'll be having John on again in a couple months to see where we stand with everything. Maybe it won't be so gloomy in a couple months. We'll see. But be sure to get everything on YouTube. Go to our YouTube channel at Zacks Investment Research. You can put that in the search bar or just do a zacks.com/YouTube and it'll take you there. But if you subscribe, you'll get all of our videos, including the top stock picks of the week. And my Earnings All-Stars videos are showing up over there as well. But be sure to get us on any of the podcast platforms. Apple, we're on Amazon Music, we're on Spotify, SoundCloud, we're on all the audio platforms. But get us somewhere because I'll be back next week with some more stocks.